Assalamualaikum warahmatullahi wabarakatuh. Today, I'm going to discuss the preliminary analytical procedures. Nature of analytical procedures. Evaluation of financial information made by a study of relationships among both financial and non-financial data. It is the evaluating financial information. So, this is done by the studying the plausible relationships between the financial and non-financial data. In simpler terms, it means looking for patterns and connections between different types of information to see if they make sense together. For example, comparing sales revenue to advertising expense to see if there's a reasonable correlation. Analytical procedures also encompass the investigation of identified fluctuations and relationships that are inconsistent with other relevant information or deviate significantly from predicted amounts. It is the investigating inconsistencies. Analytical procedures also include the examining situation where the relationships between data points are unexpected or don't match what's expected. So if the sales are significantly lower than predicted, for instance, further investigation is warranted. This helps identify potential errors or irregularities. So, analytical procedures are a way to use data analysis to assess the reasonableness of financial information and detect financial or potential problems, So it is crucial part of auditing and financial analysis. Examples of analytical procedures. Trend analysis. When we say trend analysis, it is the examining data over time to identify patterns or significant changes. For example, looking at sales figures for the past 5 years to see if there's a consistent upward or downward trend. For ratio analysis, it is the comparing different financial figures to each other to calculate ratios that reveal insights into a company's performance. Common examples include the current ratio, current assets or current liabilities, and the debt-to-equity ratio or total debt or total equity. Sa test of reasonableness naman, it is where the assessing whether financial makes sense in the context of other information. This involves making judgments based on experience and knowledge. For example, comparing the reported cost of goods sold to the sales revenue to see if the relationship is reasonable. In regression analysis, it is the statistical technique used to model the relationship between different variables and make predictions. In finance, this might involve predicting future sales based on past sales data and other relevant factors. These analytical procedures are used to assess the reliability and reasonableness of the financial information and to detect the potential problems or anomalies. Results of analytical procedures, not source of conclusive evidence. This means that while analytical procedures are valuable for identifying potential problems and assessing the reasonableness of financial information, they don't provide definite proof or fraud or error. Further investigation and testing are always necessary to confirm any findings from analytical procedures. So they provide a starting point for further audit work, highlighting the areas that need more detailed scrutiny. Timing of analytical procedures. First is the planning stage required. Why required? Because in analytical procedures, it is essential at the beginning of an audit to help the auditor understand the client's business, identify the areas of risk, and develop an audit plan. So this initial analysis helps guide the subsequent audit procedures. Substantive test procedures is not required, while the final review stage is required. In analytical procedures, it is at the end of the audit to provide a final overview and assessment of the overall financial statements. So this helps identify any inconsistencies or unexpected results that may have been missed earlier. So the slide also notes that while analytical procedures are not required during the substantive test procedure stage, they can still be performed as part of the overall audit process. So substantive testing is the detailed examination of specific transaction and account balances. While not mandatory at this stage, analytical procedures can still be useful in focusing the substantive testing efforts. So let us proceed to determine the need experts. So this slide likely to discuss the process of determining when an auditor needs to use the work of an expert, such as an actuary, engineer, or other specialist of experts. Expert is a person or firm possessing special skill, knowledge, and experience in a particular field other than accounting and auditing. It defines that an expert is a person or firm with specialized skills, knowledge, and experience outside of the accounting and auditing. It highlights that these experts can be engaged or employed by the client and engaged or employed by the auditor. So, in engaged or employed by the client, it is where the company being audited might already use an expert for their business operation, and the auditor may rely on their work. For engaged or employed by the auditor, it means that the auditing firm might hire an external expert to assist in specific areas where their expertise is needed. So this means that the auditors don't need to be experts in every field. They can rely on the work of specialists when necessary to obtain sufficient appropriate audit evidence. Situations which may warrant the use of an expert. Number 1 is the valuation of certain types of assets. It is to determine the fair market value of complex assets. For instance, the intellectual property, artwork, specialized machinery often requires the expertise of an appraiser. Determination of quantities or physical conditions of assets. So, it is the assessing the quantity or quality of inventory, especially in large or complex inventories, might necessitate the involvement of an expert in inventory management or a surveyor. Determination of amounts using specialized techniques or methods. It is the calculating for liabilities like insurance reserves or using complex valuation models may require actuarial expertise. Measurement of work completed and to be completed on contracts in progress. So it is the determining the percentage of completion and the value of work in progress on long-term contracts often requires specialized knowledge of contract accounting. Last one is the legal opinions concerning interpretation of agreements, statutes, and regulation. It is the understanding complex agreements or interpreting regulation may require the input of a legal expert. So this slides emphasizes that the auditors should utilize experts whenever the audit requires specialized knowledge beyond their own expertise to ensure the accuracy and reliability of the audit findings. The auditor considers materiality of financial statements, items, and question. So if the item under scrutiny is significant enough to impact the overall financial statements, for instance, the material, the auditor might be more inclined to seek expert to ensure its accurate valuation or assessment. So next is the risk of material misstatement. If there's a higher risk that the item could be materially misstated or incorrectly reported, the auditor is more likely to engage an expert to reduce this risk. Higher risk situations necessitate more rigorous scrutiny. Last is the quantity and quality of other audit evidence. So if the auditor already has substantial and reliable evidence about the item, they might not need an expert. However, if the available evidence is limited or inconclusive, expert opinion can fill the gap and enhance the overall audit quality. So, the decision to use as an expert is a professional judgment based on the significance of the item, or the risk of error and the quality of existing audit evidence. So, the auditor aims to strike a balance between cost and the need for sufficient, reliable evidence. Competence and objectivity. This is the fundamental requirement. So, the expert must possess the necessary skills and knowledge to perform the work accurately and must be objective in their assessment, free from bias or conflicts of interest. Professional certification and membership in professional organization. So the formal qualifications with reputable professional bodies provide evidence of the expert's competence and adhere to professional standards. So this adds credibility to their work. For experience and reputation in the expert's field, a strong track record and a good reputation within their field demonstrates that the expert's practical experience and reliability. Last is the evaluate the objectivity of the expert. So the auditor must actively assess the expert's independence and freedom from any influences that could compromise their objectivity. So this might involve the examining of the expert's relationship with the client or any potential conflicts of interest. So, in summary, the auditor must carefully vet the expert to ensure that their work is reliable and unbiased, thereby strengthening the overall quality and credibility of the audit. Risk of impartiality. This slide highlights that an expert's objectivity can be compromised if they are employed by the entity. For instance, the company being audited, or if they lack independence in relation to the entity. So this inherent conflict of interest could lead to biased findings. The auditor discusses with the client if the auditor has reservation regarding the expert's competence or So, if the auditor has any reservation about the expert's competence or objectivity, for example, if the expert is employed by the client and might be under pressure to provide favorable results, the auditor must discuss these concerns with the client. Open communication is crucial to address the potential biases and ensure the integrity of the audit process. So, It highlights the importance of the auditor in ensuring the independence and objectivity of